Good evening, ladies and gentlemen. Welcome back to Walk the Block, where you're navigating digital finance all together. I'm your host for the evening, Zenith, and I am joined by my excellent compatriot, Tracker. How you doing, buddy?
Doing well, Zena. Looking to get into topics, man. Always looking to get into everything that's going on. They're definitely, it's kind of a lull we're in. We've still been in this lull. It's been interesting, though. We had a little bit of action going on, I know, last week a little bit, but it just feels like we're just kind of grinding sideways. Same thing like the overall market. So we're going to dive into all this stuff. There's a lot of good things. There's always good things to dive into that are developing. It's just that, the price action isn't what everyone's wanting right now. So that's the only thing.
Very true. Yeah, been chopping sideways for almost 4 weeks at this point, a little more than that, honestly. So we'll take a look at the markets, both crypto and S&P 500. Might have some interesting takes on that one in particular. But on top of that, we're going to be looking into a little bit of an update on the Clarity Act. Also going to be looking at the FDIC and the Fed, trying to reassure banks that digitized assets and native assets are going to be no more burden than anything else that already exists. So some guarantees coming from there. And then if we have time, we're going to be talking Kraken and possibly jobs. So with that being said, let's get into our first one here. So coming to us from payments.com. Let's get that screen share going. All righty. Crypto bill talk stalls as banks reject White House stablecoin compromise. Negotiations over a major U.S. crypto bill, the Clarity Act, by the way, have hit an impasse. Large banks say that they cannot support a White House compromise on stablecoin rewards, raising doubts the legislation will clear Congress this year. The fight matters for payments because stablecoins are typically dollar-linked tokens used for digital transfers. An analysis carried by Yahoo Finance, Reuters reported on March 5th that talks on the Clarity Act stalled after lenders rejected the compromise. President Trump criticized banks on Truth Social and said he would not let them undermine the crypto agenda. The bill has already become bogged down since January, when banks opposed language that would let stablecoin issuers and crypto firms pay interest-like rewards that could draw deposits out of banks and make lending harder. Crypto firms, including Coinbase, argue rewards are needed to compete for customers. Reuters cited a Standard Chartered estimate that stablecoins could pull about $500 billion in deposits from U.S. banks by the end of 2028. The White House proposal would allow rewards in limited cases, such as peer-to-peer payments, but not on balances that sit unused. Crypto companies have largely accepted that framework, but banks still want even tighter limits. All right, well, the stalemate continues, is what I'm gathering out of this. And the president hopped in here to try to broker a deal. You might say he does that. He is the guy that wrote Art of the Deal after all. But it seems that the banks are really hardlining this one, especially on the stablecoin front. If you remember previously what we talked about, there were three issues. The stablecoin rewards was number one. Tokenization of real world assets was number two. And then also DeFi, security, and privacy was the third one. The second and third one have largely gone away, but this first one, the stablecoin rewards, that has been the absolute crux of this argument and the linchpin about what's going on here. So, in your opinion, is this news? Or are we surprised by this at all?
No, you're not surprised. I mean, this has been going on back and forth. The bankers, this is the line in the sand for the bankers. They don't want to give up control because their money market funds, their CDs, all those products that they have that allows them to hold large amounts of money would exodus from their systems. And that's one thing that they're concerned about. It's a new product that's come to market that they don't think is fair, but this is an evolution of a new technology and it's a competitor to them. Personally, I don't, as long as they don't want to mess with DeFi, I don't care about central exchanges. That's my personal opinion. I'm sure some others would argue that, but because I'd rather just see the bill get passed, because then we can move forward. Because then, you'll start to see prices probably, you'll have much more uncertainty with the crypto industry once this is in place, and not just for the United States, but for the rest of the world, because a lot of people are watching this around the world to see what happens. And the banks can sit there. Now, the argument is this: the United States is saying, if we're going to be the leaders in crypto, we have to show the world that we're willing to move forward with these products. But the banks are stalling. Well, if the United States doesn't move, I guarantee there's going to be other countries that'll be more than happy to step up and start to offer these incentives to be with central exchanges or in other areas. So that's the fine dance that they're having to play. But this is the line for the banks. It's too much of a threat for them. They would lose a lot of money. You would see large amounts of money leave from their money markets and things of that nature into these products. The poly markets still have a 70 chance that it's going to pass by 2026. So, the fact that it's still pretty elevated, I think it's just that they're going to have to figure out where's the middle ground on all this. But the other problem is the mid, we keep talking about it, the mid-year elections that could stall things out. So they're trying to get this in place before then. Personally, I'm a believer that they will get this passed, and hopefully they'll get it passed before or right around when the new Fed chair gets enacted, which is going to be in May. That's what we've talked about. Because if those two things could happen, and then we get a couple surprises to the rate cuts with this uncertainty out of the way for the crypto markets, that should be nice tailwinds to go along, leading us throughout the year. That would be a nice surprise. But like I said, this has got to get out of the way. And the banks aren't going to give it up, man. They're just not. So I don't know what the compromise is going to be, because to me personally, central exchanges they're not going to win this battle, man. The banks have too much pull, and the banks have too many lobbyists, and it's that those lobbyists have been around for a long time. They have a lot of important Senate congressmen in their pockets, as far as they're going to look for their best benefit. So I just don't think you're going to have enough pull to make this happen. I think they're going to have to come off the stable. I think they're going to have to pull the stable coin yield or something like that out of this Clarity Act to make it go forward.
Yeah, I think that's arguable for sure. The big surprise for me though is that we're still sitting at 69% chance. Nice, by the way, for the Clarity Act getting signed into law here. And the big one for me is I was looking at the timeline. March 5th was when we had the announcement come out, and we're only down 2 points since then. In fact, we were actually up 2 points at one point as well. So I understand that the timeline for Polymarket is just like 2026 in general, not like these consistent rolling timelines that we keep trying to get out of the White House and the administration. I think the current one that we have is before April. So we're looking at about 21, 22 days on that front. But yeah, to your point, what's going on right now is that we can't even get this out of the Senate Banking Committee. That's the real bummer here. Allegedly, we have finalized text that's been marked up and is ready to go. Haven't seen it released publicly, but at least we're getting reports of that from people that are kind of in the know here. So it's got to go to the Senate Banking Committee. Obviously, by the name, you can imagine that the banks very deeply care about this one committee, and a lot of the people that are on it, I guarantee you, are definitely sponsored or help promoted by the banks when it comes to their fundraising for re-election and stuff. We are starting to get to re-election season already. It's already primary season for a lot of places. Shout out to Texas and Brandon Herrera, who was the new challenger that appears to be the Republican candidate now. But we're seeing this stuff already happen. It's coming down the pike sooner than expected, and we're only in March of 2026. So yeah, we have a ways to go until November, but at the same time, like, you're going to start seeing this stuff be more and more relevant. I think Clarity Act, it's something that we care about deeply for sure. I don't know if it's something that the average American cares about on a huge level. I think they have a lot larger issues that they would like to see happen. So, I mean, I think that we could see the legislation come through without the stablecoin yield. I think it's just a darn shame, because like the article talked about, that is the big point of this, is that it would prevent pretty much companies from being able to compete for customers. Saying that you're just trying to stifle off the competition, there's some legitimate arguments about like trust busting and monopoly busting going on there. Granted, it's the financial industry, so I don't know how thrilled or eager people are going to be willing to try to take that on. But at the same time, it's like, this is a pretty clear-cut case, which is they have their own blue ocean market that they largely control. Crypto companies now have the ability to actually, challenge them in this front, and they absolutely do not want to see that. So till something changes, I'm honestly expecting a little bit more of the same. If anything, the only thing I'm expecting is the bill to maybe come out of committee without the stablecoin reward text in the legislation.
Yeah, I can see that happening as well. I don't know. We'll see. But like any other disruptive industry, they always typically will go after. I mean, look at the energy sector. Look at anything that's had any type of threat to their control, and they typically will either buy them up, you know, suppress them, whatever they can do to keep that power. I mean, it's pretty common to see this kind of a battle, but crypto's got a little too much legs now, and it got too much behind it to stymie. It would be a shame to not see this get passed, because like we've talked about, once this is passed, it's really hard to undo that. And that really paves the way for us going forward in a lot of different areas. But it's the yield, obviously, is going to be the battle line that banks just can't. They're not going to give it up. They're just not. So I think this is going to, hopefully, like you said, they'll remove it.
True. By the way, I do have a clip from everyone's favorite or least favorite Charles Hodgkinson here, specifically about the bill. Let's see what he has to say.
I guess we just have to pass a horrific trash bill that makes everything a security by default, and it creates attack vectors through bureaucratic nonsense for the SEC to destroy all future American cryptocurrency projects. And also, there's nothing in this for DeFi. Nothing. Uniswap doesn't get anything. Prediction markets don't get anything. Armstrong can't even get his yield-bearing stablecoins. This is not a good bill. Through rulemaking, it can become horrific and weaponized, and it doesn't cover the core of what's going on in the industry right now. Then they say we can always amend the bill later. Then why is there such a rush to pass it?
Well, there's the take from him saying it's
well. I can tell you the reason to rush it. The reason why they're trying to rush it is the administration has stated they want to try to get this in place so this is a win for them if they can get this pushed through, regardless of how the bill is good or bad, or is regardless. They'll mark it up as a major accomplishment. So that's the reason why they're trying to push to make it go through, and they can state the United States is, leading the way for evolution. The evolution of crypto, and that the United States is paving the way for the rest of the industries. That's what they're going to try to tout it as. So is he right? Yeah, he's right. But do you really think they're going to pass so many bills that just basically handicap the banks essentially? No, they're not going to. You're going to have to get these wins when you can get them. And that's just it. You're going to have to get wins where you can get them. That's it. You're not going to be able to get everything you're going to want. It would be lovely to have all this stuff, but you're just not. It's not going to happen, man. It's just not. The banks are too powerful. They're not going to give up their power.
Yeah, I think I half agree with Mr. Hodgkinson here, which is like, what's the rush to pass this, saying that we'll always amend it later. I feel like everybody knows that is just like a total lie, especially considering all the stuff we've seen pass throughout the years. It's like, yeah, we'll fix it later. Never gets fixed. So I understand that point, but at the same time, I think he might be overblowing this a little bit, which is that the Clarity Act, one of the main points is that it actually clearly delineates what is the responsibility and jurisdiction of the SEC versus the CFTC. We don't have the full text of the bill right now, so we can't really determine that. I imagine he has a little more insider information than I do. It's just a guy on the internet. But at the same time, I think that we've already seen some good wins when it comes to the delineation of powers and the determination of what is and is not a security. We already have stuff coming out from the SEC under Paul Atkins' leadership, and we also have some previous rulings even before Paul Atkins was in there. Granted, it was very limited and pretty much just saying that like Bitcoin definitely is not a security and Ethereum is probably not a security. But then we also have a decent little running list of crypto that has actually gone before the law and faced the scrutiny of what is and is not a security. So I guess shout out to XRP as well. Those guys are also on the short list of winners there. But overall, I think that he does have a point, which is like getting imperfect legislation could be an issue. But at the same time, we have no legislation. Everything is pretty much just at the direction of the SEC up until this point, shoehorning it into old rules and old laws at their behest. So it really comes down to who is in charge of the SEC and what they want when it comes to the current structure. If the current structure can change, even if it's not just getting the stablecoin yield, but it's getting some basic laws put in place about like who can do what roles based on what kind of interactions they have with customers, the resources, that kind of stuff. I think getting something down is still going to be a win. It's definitely not going to be the win that we wanted. And to Mr. Hodgkinson's point again, yeah, DeFi doesn't appear to really be winning out of this one. It's just largely centralized exchanges and arguably a bit of TradFi as it stands.
He's doing what he's supposed to. He's a huge figure in crypto. He's supposed to, bash it and all, and rightfully so, because they want perfection. We want perfection. We want it all done right, and we want it done now. We've had to go through, a lot to get this far as it is. So, but him and Armstrong at Coinbase. I mean, they are kind of those face leaders that need to be pushing the stuff to try to get as much as they can. But we have come a long way. I mean, it's come a long way just in the last year or two. So we got to get the wins where we can, and this will help with the growth of crypto, because the thing that he is missing is, even though this is a trash bill, it doesn't have everything that the true crypto folks want with DeFi and yield and all these other tools that we know that are out there that we could really leverage and disrupt the industries around the world. What it will do is bring more people to invest in crypto and try to understand it more. And then that's the kind of long journey you're going to need to get more mass adoption. By getting this clarity bill, it will then allow hopefully a pullback on some of the shorting that's been going on against crypto and manipulating the prices, and let this thing really start to take off like it should. And we can all get some wins there, at least with, our bags getting pumped for a little bit. And then we go on to the next battles to try to win the next things that we're going to try to go after. But it's I don't want to say baby steps. We've taken much more further, bigger steps than just baby steps. We've made some pretty good progress. It's just that he and others are doing what they're supposed to be doing, and we're getting there. So let's just leave it at that. That's how I look at it.
That's fair. Kind of feels like baby steps, but no, we are a good bit ways from where we were, gosh, like 5, even 10 years ago, most definitely. Alrighty, tell you what, let's shift gears a little bit. We'll stick on the bank topic here a bit. So coming to us from Reuters, U.S. regulators say banks won't face extra capital charges on tokenized securities. Okay. U.S. banking regulators clarified on Thursday that banks should not have to hold additional capital against losses when dealing with blockchain-based securities, saying that they are technology neutral. The Federal Reserve, FDIC, and Office of the Comptroller of the Currency issued new guidance clarifying that they will not distinguish between tokenized securities and traditional securities when it comes to bank capital. The agency said that they were issuing the document due to increasing interest from banks in representing ownership in tokenized securities. Quote, the technology used to issue and transact in a security do not generally impact its capital treatment, the agency said in a statement. Buoyed by President Trump's pro-crypto stance and his administration's push for friendlier crypto regulations, the crypto industry last year rushed to capitalize on a surge in the enthusiasm for the sector, with companies like Robinhood, Kraken, and Gemini all launching tokenized stocks in Europe. The industry says tokenized shares, blockchain-based instruments that track traditional equities, could revolutionize stock markets by allowing shares to be traded 24/7 and settled instantly. This would boost liquidity and reduce transaction costs. A few of the companies have issued their own experimental stock tokens on the blockchain software that acts as a shared digital ledger, but most tokenized shares are pegged to public companies and issued by third parties. Other companies, including BlackRock and Franklin Templeton, offer tokenized treasury products. So, this, in my opinion, seems to be a little bit of the precursor to the entirety of the stock market moving on chain, allegedly. But at the same time, this is kind of just the faux version of that, which is that, yeah, sure, you can buy digital representations of this. It's not the real thing. It's pretty much like a digital representation of the real thing held by someone else that you're contracting through. But at the same time, like, the core issue here was that the banks were worried that any sort of this stuff would be, regulated or have different requirements for what kind of capital they have to hold in its stead. To me, there's a bit of a great irony here, which is that they're like heavily fighting against the crypto revolution, but at the same time, they're like, hey, we don't want to have to hold more stuff. And it's like, okay, cool, pass the legislation and you won't. But all right, I guess we're throwing them a bone anyways.
I think it's funny. This kind of reminds me of how you would always be charged when things were going into more of a digitized solution with the web and everything. You just get charged a convenience fee because they've had this technology to make it quicker and faster for everybody to use. This is kind of falls in that same category. But the nice thing about it is they're reassuring the banks that, hey, you're not going to have to pay anything extra. Like the rails are greased for you guys to come in and do mass adoption now. All these agencies are already very pro crypto. Let's just go. Let's get going here. So that's how I look at it as. The only thing that's holding up the train right now is the banks. That's it. There's nothing else holding this up. It's just they need to agree with it. Well, certain senator and congressmen that have to vote for things. I understand that. But what I'm getting at is the banks need to just either agree or try to work some out, and then this is just going to happen. And keep in mind, a lot of these banks that are arguing this, they've already moved over and started tokenizing things already on these chains. Like they've already started to get, you can call it like proof of concept and seeing how their products are going to work and how they're already working on all this stuff. So this isn't anything new. It's just that this is another great thing to state that good. You don't have to worry about the FDIC. You don't have to worry about the OCC. You don't have to worry about any of these other regulators that are going to essentially become an impediment. The Fed's even behind this. I mean, so yeah, it's happening.
Yeah.
Well, one other thing I wanted to throw here that I don't think people understand too is there's also a big push to move a lot of the data to cloud solutions. And this has been happening. This has been going on probably for the last 5 to plus years. But it's been getting more and more aggressive. A lot of the big companies out there, certainly in the United States and other places around the world, they're moving all their data to centralized cloud farms, whether it's with Microsoft, Google, Amazon. Those are kind of the big ones. There's other ones out there, but those are the big ones. So we're moving all the data there. Now you're going to move into tokenization. So everything is going to be inoperable essentially here, where they're going to have all the pieces in place. Is it going to be good in some aspects? Yes. Is it going to be bad in other aspects? Yes. It's all companies are doing this. This is something that's been moving. You can, in the technology industry, you can see all the pieces starting to align. Everything is getting there. It doesn't seem to be slowing down. People are not understanding why are you doing something. Some people will tell companies that, oh, you're moving to the cloud because it's going to save your company money. That's BS. It doesn't save you anything, not by a long shot. It actually costs a lot more up front because then you have to do a lot of other reworking of your solutions and factoring them to actually harness the abilities to save as much as possible. But the big push here is to move all data to centralized cloud areas. But like I said, I'm just trying to connect the dots for those people out there. So once you have that in place, now you have this tokenization in place and to allow them to start moving it. Banks and industries are already starting to work on these products. It's almost like we're just watching theater right now between the banks and them really fighting over yield capital. That's really what we're talking about. That feels like the one piece that's just holding up this entire thing from just really manifesting quickly. Before it's going to basically get passed and things are going to start moving so quickly, you're going to see products and things pop up very quickly, and it's because they're already working on these things.
Yeah, I mean, we've been talking about things getting tokenized for a while now, and getting tokenization is kind of like the next step of the whole cloud-based infrastructure. So it's going from cloud to blockchain effectively. And to your point, I would argue that just because you're going cloud doesn't mean it's going to save you money. In my opinion, it's actually going to complicate a lot more things. Sure, you can access files anywhere you want, but at the same time, theoretically, you could still do that with your own personal file sharing on your own servers. It's just, in my opinion, it seems like one more failure point in the chain. So the bottom line for me, to bring it back down to earth, is like, the banks are really the ones that have been holding this stuff up. They've been doing a handful of ways. One is through legislation. Two is kind of through complaining to the regulators about not wanting to have to go through additional hoops, even though they're kind of asking for the additional hoops to still be there because they want it to be treated differently as opposed to them. So they're kind of the roadblock right now. It's going to take some effort to figure out how to get them to move, whether it's incorporating them into the new system, maybe a little bit of payoff or kickback or something like that. Or I don't know, maybe just finally beating them once and for all. But I think that third option there is probably the tallest order.
Yeah, but we already talked about this. And the solution to me is, it's funny how the banks are holding this up, because really I look to the banks as they have all the power. The crypto and the central exchange in the grand scheme of things. And if they do come out, the banks can certainly, buy massive amounts of shares of these stakes in these companies, which they've already done, and they can get in there and either, really be on the board of directors or be the majority shareholder, or they can get in there and simply do partnerships with them. So they're going to have their hands in this pie. They're going to be a part of this. I think they're trying to, another way to look at it, they're probably stymieing things because maybe things are moving a little too quickly for them, and they want to make sure that they're positioned properly before these things start to happen. So it could be that piece too. They're just trying to stall for time, which has certainly been the case when the previous SEC administration, because that's what they were put in place, was to stymie the developments of the industry, and that's why and they were very successful at that. So I expect them to keep. I expect all this to get passed. Like I said, I think the banks are going to have. They're not going to. The banks aren't going to be losing out on a lot of money. They're just ain't going to happen. They're going to be positioned to profit it very much. If not, if anything, probably even profit even more by doing this. Because if you tokenize it, it's going to cut overhead costs. You know, they've already stated that that's what they are attracted to. Is it's quicker, it's faster, it's a 24/7 operations now. It's not just during regular business hours. It's going to open up those products. I know Tom Lee and others had talked about, you know, the types of products that could open up, where with tokenization, you could, I mean, you can get in there, and it was pretty fascinating that some of the products that they're already looking at. But you're going to see innovation is going to be sky's limit, because it's 24/7, 365 days a year. You can buy tokenization, which mainly you can buy portions of things. It's going to change how the option markets probably work. It's going to change how a lot of different things work. So it's definitely going to be, the financial institutions will be like on steroids, essentially, with all the products that will be coming out to really work any angle that traders or investors are looking to try to capture. So this is just greasing the tracks.
Greasing the tracks for sure, definitely. Alrighty, let's shift gears again real quick. We've got a chart, but it's not exactly a crypto chart. This is the S&P 500. You might notice that our latest green candle has gotten down a bit further than anything previously. So before this, we were kind of trading up above this like 675 range. Every once in a while, we drop down to that 670 level. But today on the open, started at the good old devil's number, 666, got all the way down to 662, but then finally closed out the day back inside of the range at about 678. The more interesting point that I think Tracker was the first one to point out here is that this appears like it could be the start of a trend reversal. What I'm saying by that is we had our all-time highs, we kind of had this range, but more importantly, you could argue this could be the start of a head and shoulders pattern. What we're talking about that is pretty much peak up, drop down, new peak, the highest one, drop back down to that older bottom, lower high from the last one we just had, and then we start going the other direction. So, sir, please make your case. What do you see in here?
So what I'm saying here is that the overall markets are starting to, I mean, it's topping out. Look how far this has been happening. If you zoom out, these are long-term charts. So scroll out and now expand it. Typically you have a rollover in markets. It takes some time for it to manifest. And now you're seeing here where it's been going on for what? The go back to zoom in more closer to the current time. How many months are we looking at here? This has been going on. This topping pattern has been happening since, you know, Q4, and now we're going into we're almost finished with Q1. So this is a typical rolling over process. Now, whether or not you get a true head and shoulders, that's irrelevant. I'm just saying, it's just, you can see a topping pattern going on.
That's fair. Some of the things I'm looking at, this is the weekly, by the way, is that my red line here, that's our 9 weekly moving average. The yellow is the 20, and our orange is the 50. It appears that, well, we're starting to see a convergence between the 9 and the 20, showing that we're starting to maybe converge and head in a different direction. That's one of the things that I look for when I look for these reversal patterns. Zooming back in on the daily, similar kind of stuff. The averages have largely been pretty tight, basic fluctuations going on, but now we're at the point where on the short term, 9-day average, the bottom one, 20-day is our middle one, and the long term is the top one. That's the kind of stuff that I look for when it comes to these reversal type patterns. Not saying anything is guaranteed here, but just looking at the fundamentals, moving averages starting to shift in the opposite direction. They're stacking in the inverse towards the downside now. And then additionally, if I'm looking at the relative strength indicator, that's my bottom one here, price has been kind of going up and to the right, but the overall sentiment has been going slightly down and to the right. And we keep making new lower lows when it comes to this sentiment indicator right there. So handful of factors. As far as the overall marketplace goes, we did get a jobs report this for February, where we actually went down about 62,000 jobs for the overall economy. Previously, up until that point, we've been averaging about like 15 to 20,000 plus added to the economy every month. But this is the first data point where we actually see something heading towards the downside. So with that, and then a bit of instability going on with the U.S. and Israel doing joint strikes on Iran currently, you could argue that that little bit of turbulence can be spooking the markets a little bit. I know some of the headlines I've been looking at are saying that we're entering possibly a period of stagflation because Unemployment ticked up from 4.3 to 4.4%, despite being at 4.5% like 3-4 months ago. And then they're arguing now that with Iran no longer really producing oil in the Strait of Hormuz getting blocked off, saying oil prices are going up, energy is very important. But at the same time, I think there's other economic factors to take into the global stage. If you remember, back in January, we kind of took out Maduro in Venezuela, and then part of that arrangement was oil. So yeah, just because Iran's shutting off doesn't mean that there aren't new sources coming out here. So my take on this one is, look, a lot of stuff going on. Possible trend reversal when it comes to the S&P 500. Might not be the greatest thing in the world when it comes to everyone's 401k and whatnot. But at the same time, this is kind of just normal chaos or turbulence that I would expect going on. I am curious, though. Let's go check out the WIX.
Well, I was going to say the VIX. Yeah, the VIX has actually spiked pretty hard today. It really skyrocketed up to 35. That's a nice big spike. That's true fear in the markets is when you get to those levels. Now, are they typically short-lived? Yes, but you typically get a very choppy VIX where it'll spike really aggressively. Then we have a pullback. Then it could spike again and once again, the VIX is really just a measurement of uncertainty. When it stays down low, it's very calm, nothing to see here. But then when it's spiky, there's obviously major events, typically macro events or what's happening here. And of course, probably, take your pick. It could be the administration tweeting. It could be, the war that's going on and stuff. Personally, I don't think this thing's going to last very long. I know there's people that are freaking out. I know there's all these rumors coming out. Now they're talking about, people are throwing out the word draft, and any of these kind of things can start to spark people from things. But these are headline news, man. But yeah, so anyhow, the VIX really spiked hard, got up, then it dumped back down into the 25, but it did spike up to that 35. So that's a pretty big jump. One thing that I was noticing was the company Circle, which is the one that owns the USDC stable coin. It has really had a hell of a run here lately. That's basically, you're looking at a 2x almost, just on this green part here at the very beginning. Look there where it had this big gap up. No, not that point. I'm talking about what happened starting on February 25th. It had a huge gap up from that bottom right there. Yeah, dragged down. You got close to almost a 2x there in a Circle price. That's a massive move. Their earnings came out. They're basically being positioned to do pretty well. It's a pretty big spike. It's been gradually going down. So, that tells me a lot of people are looking at Circle as being something that could really expand and could really do some stuff. It's a pretty big move for a stock. A 2x in what? 2 weeks?
Pretty much.
Ish.
Yeah. A little more than 2 weeks.
It's a big move for a stock, man. And I get it, Circle really spiked hard because when it first came out of the gate, it was really running hard. But that's a pretty big pump. I'm just saying, the reason I'm bringing that up is because of the Clarity Act with the stable coins that are the argument right now. So it's interesting.
Yeah, we've covered this a good bit in the past as well, which is that out of 2025, honestly, some of the big winners really were stablecoins and stablecoin related projects and companies. Circle, obviously, the issuers of USDC, some of the biggest winners when it came to everything that came out of the crypto summer back in 2025 with the legislation, namely just the Genius Act. So am I surprised to see that they've had a big resurgence, especially on a nice earnings report there? No, not especially. But at the same time, it kind of marks a bit of the overall trend here, which is that they peaked really hard back in June and July of 2025, right when the legislation came out. Since then, declines. October, the famous October 10th candle right there. I can see it to the day. And that was the start of the decline. And then we've haven't exactly been matching the Bitcoin price 1-to-1, but the overall trend, if you kind of squint, you can definitely see it, which is like, look, crypto's been cooling off for sure. A lot of interest around crypto has definitely been cooling off as well. If you look at some of the indicators about like how much is it being searched, what exactly are the search terms, overall usage, that kind of stuff, Bitcoin is definitely in a bit of a winter when it comes to attention. Price is down, obviously, but it's not cratered by any stretch of the imagination. So seeing a good earnings call to help boost things back up into a time where Clarity Act is kind of at the forefront of negotiations, whatnot. No, I'm not surprised, but at the same time, hats off to those guys. It appears that you are running a successful business operation. I have some qualms about how you sort of extort chains to, get USDC onto a blockchain, but that's neither here nor there. And I'm not going to be changing that anytime soon.
Well, it's funny how everything's really calm and quiet because price action has been horrific, right?
Oh, yeah.
Like retail has just really, no one's talking about it. I mean, you have obviously the memes that are out there about the commercials during the Super Bowl. People are booing at the TV and everything for crypto. So it's definitely in the tank right now as far as not being liked. But it's funny though, but all the big whales, the institutions and all the big players, they're accumulating. There's talks brewing behind closed doors on what's happening. So they're positioning themselves, certainly. I know we beat this drum all the time, but smart money's buying. Institutions are buying. They're positioning themselves for the long run. They see this being the kind of the foundation being laid for this new industry, essentially.
That sounds about right. And I think the data is starting to confirm it a little bit. Coming over to CoinGlass, looking at our ETF inflows, outflows, pretty much up and down. But over the last 2 weeks, pretty much since that September or February 23rd date, it's been a lot more inflows than outflows. Granted, it's still nothing that's going to surpass all the stuff of the previous quarter and whatnot. But at the same time, it is a notable shift, or at least an inflow coming in here. I do have some of the data pulled up. Let me see if I can grab that real quick. Yeah, over the last 14 days, we've seen about $1.4 billion in net inflows. Big contributors of this were the BlackRock IBIT one coming in with $1.1 billion during the time frame. Grayscale had about 55 million. Arkham had about 90 million. And then additionally, Ethereum also doing not too shabby itself. Pretty much 23 million for 2 weeks ago. And then last week, 80 million itself. So overall, there is money coming in. It's not blowing anything out of the water, but if you look close, there are movements that are happening behind the scenes, even despite everything going on with price. And which, by the way, the Bitcoin price is largely pretty much stayed very flat since the 6th of February. The only big thing of note that we had was that we did come all the way up to about $74,000 on the 4th and 5th of March. That was notable because that was coming up above our 20, or excuse me, let me shift this. You got to be 200, not 9. That's for my stocks. Coming above our 20-day moving average indicator, not quite hitting that 50, but coming above it, trying to retest that one. Did dip below it for a day, but now we're back above it. The TLDR on this one is like, look, price is chopping sideways. We're getting signs of life, but nothing that's really revolutionary by any stretch of the imagination. And additionally, if we look over at the old Bitcoin Fear and Greed Index, we're still sitting very low, and we've been sitting low for a long time. This is our 3-month timeline, by the way. On the 5th of March, when we went up to about 75,000, got all the way up to 22, which is out of extreme fear and only into deep fear. But now we did drop back down to the single digits on the 9th, and we're currently sitting at about 13 here. So again, with everything approaching that
January 18th spike. Sorry, go ahead.
Yeah. I was going to say, right now we kind of have a culmination of stories, which is like Bitcoin Fear and Greed, largely depressed. Price, largely depressed. Attention, largely depressed. Any action with Clarity Acts, largely depressed as well. And the overall market movements, they're making some movements, but this is not the largest period that we've seen by any stretch of the imagination. So it's definitely a quiet time. Odds are, if you follow a 4-year cycle, yeah, you could argue this is definitely confirmation for bear market. I do still think that there is potential for a rally out of it, but at this point, I do still think that if you had to make me guess, I'd say 70% odds we're in a bear market, 33% or 30% chance that we can have a rally from here. But that would take some factors. I think Clarity Act would have to be a big one, and then also finally seeing even more of the institutional rate cuts would help for sure, but also more institutional flows of capital would help, because at this point, I don't really see retail being able to pick up the ball and spike it from here.
Yeah, and keep in mind though too, we went on for 3 months kind of choppy sideways action before we dropped to the next leg down. That Fear and Greed Index on January 18th, I think, had the peak, and that was right around when we cracked and we started going straight down once the Fear and Greed Index got a little on the high side. So yeah, I mean, could we see another leg down? We could. The thing that, if I'm looking at it as market makers, if everybody's looking at certain prices, and trust me, they know what most people are looking at. They know that the price gets down to a certain point, it's going to open up a lot of people who are on the sidelines trying to get back in. I don't necessarily know if they're going to want to allow that to happen. So we'll see. That's the one thing I could see them faking people out and not allowing to get down that low. We'll find out though.
Yeah, not allowing it to get down low, I think, is an interesting point that we've been talking about this cycle, especially with the introduction of traditional finance. Because a lot of big money is in here, you could argue that, well, retail investors are here for the volatility. Traditional finance might not be. So if they have anything to say about it, they do have the bags large enough to keep buying up price to ensure that bottoms don't really get any lower than they are already. But at the same time, that is a tremendous amount of capital. And I'm just curious if they want to deploy it in this space or if they have other better areas to deploy it instead. Because it is a competition at the end of the day for each of the dollars about where it goes.
Well, it's funny you say that. I mean, everything else is run pretty far. So if you're looking for growth and you're looking for a new industry, and then once, like I said, once we get this Clarity Act or some regulation in place, then it should be a pretty good bet to go forward in that area. Of course, it's treated as a risk on assets. That's why I'm saying the rate cuts need to keep coming with the new Fed chair it comes in. And another reason why those rates could start to happen is, I mean, the housing market, we were talking about this, probably about 3 weeks, 4 weeks ago. You're already seeing major housing crack bubbles starting to form in major areas in the United States. That's already been happening. So that would be another reason to push for the rate cuts. And typically the way it happens on the rate cuts is, if enough industry areas are asked, so how do I put it? If you've got a bunch of industry in DC and they got their lobbyist friends in there and they need help, well, enough people are screaming, enough industries are screaming we need lower rates to help it out. Typically that's when you can start to see aggressive rate cuts coming, because it's just getting beat up. Now I get it, the Fed, they look at their data points. Certain Jerome Powell, he's a data driven guy, but they're going to go off of the data. But if the data is looking really bad, industries are telling them they got to cut rates. It's just more pressure, more political pressure on them to basically make a move. So in the new administration, it comes in May. Obviously, he's was selected because this administration is all about cutting rates. And I know we keep beating this drum a lot, but we'll wait. We'll see in May when that new person gets in place. We'll see how it goes.
That's true. Speaking of which, we do have a bit of a big month coming up here because, yes, we have a Federal Reserve meeting on the 17th and 18th. 18th is the date we're actually going to get the announcement of what's going on. We did get all of our fancy documents last time around, so we're not going to get an updated projections this time. We'll get those at the end of April, though. So that is going to be a big one for all the people that like diving into the data. That's me. But on top of that, currently looking at FedWatch. Let's update it for today. 97% chance of no cut. This is not a surprise. Right. If anything, it's been rising. We were looking at 96 and 82 when it came to last week and the month before. So is this surprising? I think the answer is no. The data hasn't really been moving on inflation or unemployment. Yes, we had one bad jobs report that came out for February, but at the same time, unemployment ticked up from 4.3 to 4.4%, staying well within the range that it's been in for like the last 6 to 9 months. And inflation is also appearing to be on a trajectory down towards that 2% area. But realistically, I think it's probably going to approach 2.5 and might get stuck there for a bit.
Plus, with him exiting, I don't see him doing anything aggressive or surprisingly before he leaves. Data would have to get really bad for him to make a move, and I don't know. And if it does, obviously he might, but I don't think, unless we get a surprise, he's not going to take any action at all.
Yeah, Jerome's going to be looking for multiple data points confirming an overall trend, and he's also going to be looking for something that is a change in the overall status quo of what's been going on with the economy. As of this point, I don't really see any change in the status quo. Yeah, sure, we talked about it earlier, which is like with the Iran stuff going on right now and the price of oil in flux. It went up. It also went down today, by the way. That kind of stuff is just, it's chop. It's noise. It's not really going to be anything that's changing the overall conditions. So that's what I'm seeing for the near future. Pretty much, look, we got Jerome for 2 more meetings. We have one bad data point for February. It's going to take multiple confirmed bad data points. So at best, and by best, I mean things kind of take a turn for the worst. I think that realistically, you might see something happen at the end of April there, but odds are, I think the answer is no. Yeah.
Correct. Nothing.
Yeah. Alrighty, tell you what, got one more story for you here this evening for all the crypto folks out there. This is a bit of an interesting one, and again, culmination of a lot of different stories we've been touching on lately. Coming to us from CoinDesk, Kraken becomes the first crypto company to secure a Federal Reserve master account access. The approval lets Kraken speed up deposits and withdrawals for large traders and institutional clients, but it is limited. They've now secured the master account, giving its banking arm direct access to the Federal Reserve's core payment systems, making it the first crypto company to operate on the same rails as traditional financial institutions. The company said its unit, Kraken Financial, received approval of this master account. The account provides direct access to Fedwire, a major interbank payment network that processes trillions of dollars in transfers each day. Until now, Kraken had to rely on partner banks to send or receive US dollars. Direct access changes that flow as the firm can now settle payments itself, which may speed up deposits and withdrawals for large traders and institutional clients. So, big news, or is this kind of it's neat, but we'll see what happens?
It's big. It's big. Well, here's the question I would have to ask: do any other industries outside of the large central banks have access to this?
I don't know, but I can try to find out for you.
Well, the one thing that I find that's interesting is who's to say they're not approving this because maybe they want to try to, once again, do proof of concepts. Maybe they want to set up this line of credit. Maybe this is going to maybe look at trying to tap into setting up the new payment rails and everything with blockchain. I mean, it's potential that they're trying to work on things to see what's going to work and not work. So maybe Kraken, since they got way ahead of everybody else and submitted for this to happen, they're approving it because, once again, it's crypto-friendly administration. But like I stated, they can now put these pieces in place to see how it would work if they were to try to do direct lines of access. Maybe, and like I said, maybe they are going to try to see if they can do it on the actual blockchain. It'd be interesting.
Fair enough. Based on what I'm looking at here, this is actually not a very common thing outside of the banking industry. Pretty much what it's largely used for is only depository institutions. So this is going to be commercial banks, savings banks, credit unions, branches of foreign banks, that kind of stuff. Other people have tried, like payment processors, but Kraken is kind of breaking into some new territory here when it comes to this kind of access.
So it's a non-traditional bank that just got access to it. So yeah, it's news, definitely newsworthy in the financial industry.
I had a little more bullish take on this one because I think that this is a serious step toward legitimization of crypto. Obviously, the industry is very largely pro-crypto at this current time. And one of the central exchanges, not the largest one out there, but arguably a top 5, top 10, now has access to the Federal Reserve payment system, basically the source of the world reserve currency. I think that this is a bit of a massive step. It's going to be on them to figure out how to make the best use of it. But I guess the black pill take here is that as a user, are you going to see any difference? The answer is no. But when it comes to the overall power struggle going on, I think it's actually a pretty big step forward because this cuts out the middleman, which is banks. And as we've talked about all stream, banks are large enough and powerful enough that they can pretty much directly affect U.S. legislation through their funding of representatives, and also have a stranglehold of a monopoly on anything when it comes to finance. Being able to circumvent them and deal directly with the Federal Reserve, I think, is a massive step forward. Granted, it doesn't do anything for the customers, but when it comes to the industry, if we saw more of this happen, I think this could really change the tide when it comes to the power struggle going on between banks and centralized exchanges, as we've talked about at the beginning of the episode.
Yeah, I mean, agree with everything you're saying.
Feel free to tell me I'm overhyping it because that's a fair critique.
No. It just keeps adding more clout to an industry that's still very new. It's growing. This is just another piece of the puzzle. Yeah, it's faster and cheaper fiat movements. Sure, stronger institutional offerings because it's going to allow on-off ramps of crypto to fiat, and that's going to bypass the banks, of course. So that's really good. Obviously, it's one of the first in crypto. Like you stated there, that unlike the it's not what is it? It's not a full unrestricted master account like traditional banks get. So it is limited. It states it's a limited purpose account, 1 year internal term. So that's it's kind of, they're like, all right, we're gonna let you play around, but you're gonna have to we're gonna kind of dip our toe into this, see how you guys do before we open it up, basically. But yeah, it's definitely going to be a key thing that I think that this happened. I mean, anything that they can bypass the banks, because if they start bypassing the banks, then the question is once again, like, why do I need the bank? Why do we
There
need
you go.
banks? But you're talking about a juggernaut industry that, like I said, goes back to what we said at the beginning of this entire show. They're going to protect their area, and rightfully so. But yeah, I'd love to see the central exchanges and things take over and try to move it. But like I said, the banks are still going to be involved in them. So it's almost like it feels more like theater at this point. The banks just need to kind of understand that they have a way to position themselves. And it's just another product out there that they could utilize and be a part of. And they don't really have to give anything up because they can still be major shareholders on the board of directors for these publicly traded companies, central exchanges. So yeah, there's nothing stating that they can't let this go. I don't know. I think it's more theater than anything.
I can understand that, especially when it comes to the fact that it is a 1 year limited account. I'm hoping it's just a trial run for a more successful partnership in the future, and possibly a trial run for the rest of the crypto industry to actually start getting these kinds of accounts. But yes, I understand that it's a bit of theater, but at the same time, a win's a win, and I'll take it.
Yeah, I'd be interested in like I stated, I don't necessarily think it is, but it would be interesting if they are doing this to try to also see how can the Fed leverage a newer on-chain product to see if money can move across through tokenization and stuff like that as well. I'd be curious to see if they're trying to work on things like this as well. Something to keep an eye on, because I could see things come out of this, because it is a proof of concept that's new. But I'm saying proof of concept from the non-Fed wire way, but setting up maybe a new rail system that Fed wire is going to be using blockchain to start testing this, on-chain direct payment system like that. I'd be interested to see if it comes out. Yeah. More around the technology than the actual fact that they're getting Fed wire. I get it's great for the crypto, but I think that's something to keep an eye on.
Very true. And as far as how the Fed could leverage this relationship, I don't really know, to be honest with you, because the only thing that they want to ensure a stable system to help ensure that the US dollar is doing well in the world. Crypto has definitely been the boogeyman up until this point for everything illegal and scandalous, but reports are showing that crackdowns on kind of illegal activity are happening. People are doing a better job at tracking stuff that's getting around sanctions, whether it's Iran and Russia kind of stuff. Reports have been coming out showing that people have been getting a little more vigilant when it comes to watching that kind of stuff. So it ultimately could be useful to the US dollar in helping pretty much keep the barriers that are already in place. But I think that once you kind of get this cat out of the bag, DeFi has the potential to really take over. And the more people that are using the system, the more people that are going to look into DeFi, and that will truly open up their horizons. So it's beneficial for the United States because they have an interest in getting ahead when it comes to the crypto game. This is one of the ways to help ensure that the industry is growing reliably here at home. Excuse me. And then on top of that, it could also help them kind of keep some of the existing safeguards in place that exist for the US dollar. And by having the partnership, they can exert some sort of leverage or force onto the exchanges that are also dealing in the crypto that the naughty people have been using to get around the government for a while. So could be good, could be bad. Again, time will tell. We just got to wait and see on this one.
And keep in mind, though, the stable coins are still being used to buy up a lot of U.S. Treasury debt.
Yes, sir. Always. Always got to keep those reserves. And what's the great reserve? Apparently.
So the U.S. government definitely wants stable coins to keep pushing forward. Probably why you're seeing also Circle move like it is, because it's probably getting involved in some type of transactional fees and stuff that they saw on their quarterly reports. That's probably another reason why it was doing it.
Fair enough. Tell you what, though, we will continue to monitor this one, the markets, and everything else. And by the way, folks, if you want the latest and greatest on everything that we talk about here on the show and you want more, you can go ahead and hop inside of our Telegram where you will find all of that, including fun live streams, our ongoing chat, and any sort of questions that you guys have for us. We're trying to help people learn and build their own strategies so that we can all work together and research together and ultimately end up ahead of this one. So we like to say around here that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. When we all work together, we can all win together. Alrighty. That pretty much does it for this evening, good sir. Do you have any final thoughts?
Telegram as well. Something else we're looking to do is we're going to start diving in. We're going to start looking at videos of actually really good content and concepts that are out there to really dissect them together in this Telegrams. Like we're going to start going through them because there's a lot of great, here's the thing, there's a lot of great material out there, but not everybody understands the material when it's being presented. There's a lot of advanced stuff we don't even talk about on this show that that go on mainly in the DeFi area. A lot of stuff happen in the DeFi area, a lot of new products coming out, things that, but unfortunately, most people, even if you receive it, have no idea what that even means and how that even works, or what do you even do and where do you start? And then how to safely use these products. So there's a lot of stuff there, don't lie. So there's a lot of good stuff we can have with very solid conversations around new technology and new products that are out there and start having a roundtable discussion. So that's what we're looking forward to start moving into next.
Well said. Alrighty. Well, that pretty much is it for tonight, folks. S&P 500 looking like it might be a bit of a top. Crypto had small spike, but nothing world changing. And then outside of that, yes, the world continued to spin despite the VIX going up and all the stuff going on geopolitically. And yeah, keep your eyes out on the Clarity Act. Apparently, the betting market still has it as the favorite to pass by 2026, but as of right now, still at a standstill thanks to the banks. So maybe if you got one of the senators on a banking committee, you could give them a call or an email or a strongly worded memo through the mail. But anything helps. With that being said, we'll catch you guys next week on Monday at 9 p.m. Eastern time, like all of our streams here. And outside of that, if you want even more of the latest and greatest and more direct access to us and our fantastic community, please head on over to the website, walktheblockndf.com, and you find the link to join our Telegram inside of there. With that being said, ladies and gentlemen, thank you so much for joining us this evening. Until we guys catch you next week, I hope you have a good one. With that being said, good night.